Hey everyone, this is Jay Thomas with the next section of Digital Greed. This one relates to my analogy between earthquakes and markets and price action, which might sound really interesting, but I think it is a really good analogy. So let's get into just the very basics of earthquakes. So let's say there's two tectonic plates sliding against each other. Occasionally they slip, and that causes an earthquake. So they move rapidly all at once, and earthquakes occur because of that. So maybe you have two plates where on average they move, let's say, 2 inches per year. But that's not every year. Every year they don't just decide to move 2 inches at noon on June 2nd every year. No, it's much more random than that. So a lot of times the pressure will build up for years even. It could be like 10 years between earthquakes. So that pressure could build up for 10 years, and then the earthquake happens and the plates slip 20 inches all at once. So even though the average rate is 2 inches per year, it could all happen on one earthquake every 10 years, or maybe there's an earthquake after 5 years and it moves 10 inches. So it's kind of random and sporadic. But the point is that this pressure builds up over time very slowly, and then all the movement happens in very short periods of time. And so that's very similar to how markets can work sometimes, where either buy pressure or pressure to sell slowly builds up, and then it all happens, the price changes rapidly all at once and reflects that new sentiment. So let's look a little bit further into that. So in trading and in markets, that change in pressure is kind of a change in sentiment. Now, if we look at maybe the easiest example is Bitcoin, although this works in many parts of the market related to technical analysis. But let's just look at kind of Bitcoin end of 2020. So there's a lot of people hearing about Bitcoin for the first time. They're intrigued, but not necessarily convinced enough to buy in. But they hear about all these new investment banks buying some Bitcoin as a kind of a hedge against inflation or as a store of wealth. They're putting it on their asset sheets. More and more famous investors getting in. Elon Musk buying in, that type of stuff. They see more and more people getting in, especially these famous people. So they're becoming more and more intrigued. And then there's some type of trigger that just causes them all to decide to buy in at once. So for a lot of people, that could have been Elon Musk deciding to buy into Bitcoin. But the point is that demand is slowly increasing on the sidelines, hasn't come in yet, so it's not affecting the price, but there's a certain trigger that causes a bunch of it to rush in all at once, and then you get a rapid price increase. This also works on a smaller scale with technical analysis. Let's say there is either like a price resistance. The price of something is going up, but maybe it's hitting $100, can't quite get through $100. But maybe there's a bunch of people on the sidelines who want to buy in, but it has to break through 100 first. They don't want to buy it if they think it's not going to break through. So they're all waiting for that to happen. Once it does happen, a bunch of those people buy in, and maybe the price jumps 20% in a week up to 120, just because it was able to get through that level of resistance. Same thing on the downside. There could be price support at $100. A lot of people holding it. But it looks like it might go below 100, but it's been holding pretty steadily, so they don't necessarily want to get out right away. But if it breaks through that and starts going down, they might be incurring losses or panic or whatever, but a lot of those people will get out at the same time, roughly, and the price will drop rapidly. So this kind of earthquake analogy, I like to think about a lot of price action like this. A lot of people changing their opinions, but not necessarily buying or selling right away until a certain threshold is released or something triggers a lot of people to get in or out at the same time. This view of the market makes a lot more sense to me than just a traditional supply and demand that's not really related to changes in opinions. And with that, kind of on the same level or the same idea of this earthquake analogy, is my view of different investors in a specific market. So if you are someone just getting into, let's say, the Bitcoin market, you're researching Bitcoin, you're trying to figure out whether or not you want to buy. There's various reasons why people want to buy Bitcoin. So some of them might want to buy Bitcoin because of its properties to be anonymous. They want to hold a coin that's anonymous. Well, Bitcoin's not quite as anonymous as people originally thought, so that might be a bad reason to buy it now. But there are a lot of people that do like Bitcoin, at least historically, because of their views that it's a more anonymous coin. So there's that one group that wants it for anonymity. There might be another group that wants to buy Bitcoin to process transactions. They think it's going to overtake other means of payments, so they buy Bitcoin purely because of its transactional use. They don't want to go through banks or third parties. They just want to use Bitcoin. And then there could be another group that buys Bitcoin as a store of wealth, similar to gold. So they might not care about transaction speed or number of transactions or using it as a currency at all. They might not necessarily care if it's anonymous. They just want to buy it as a store of wealth. So all these people are investors in Bitcoin, but their opinions are different. However, a lot of people share similar opinions. So if you were to ask 1,000 Bitcoin investors kind of their opinion on each of these things, you would probably find out that although there's these few different opinions, most people's opinions align with one of these different groups. So it's not like everyone's opinion is completely unique. It kind of clusters into these different regions of different sentiment. So that's how I like to think about investors of anything really. Rather than everyone having a unique opinion, they kind of get sucked into these different clusters. And that's just because of just humans' bias to want to kind of fit in with different groups. They kind of get the same information. It's hard to go against. People want to be in groups like this, so it would make sense that investors kind of split into these different groups. And this works really well with the earthquake analogy, because if you view investors as people in these different groups, different news articles affect those different groups differently. So for example, if Bitcoin comes out to be a news article comes out that says Bitcoin is not nearly as anonymous as people thought it was, and there's definitive proof of that, which I think's happened lately, or at least in the past few years. Bitcoin's not nearly as anonymous as people once thought it was. So that whole group that's investing in Bitcoin just because it's anonymous, well, now that whole use case is kind of gone, or it's been diminished. So a lot of those people might want to sell. Whereas the people investing just as a means of payment or to store wealth, well, those people might not care as much about the anonymity of Bitcoin. So they're fine. But the entire group that hoped it was anonymous, they're kind of annoyed, and they might all decide to sell. So that might be a buy signal for the other. I mean, if the price crashes rapidly because that entire group leaves, now the other groups of people that don't necessarily care about that news or that part of Bitcoin, now they might have a buying opportunity and jump in. And the same thing happens with the people that want to just use Bitcoin as a currency. Maybe Bitcoin can only do 7 transactions per second. So they might, if other coins are doing better or have a higher number of transactions per second, they might go to these other coins where that might not affect Bitcoin's store of wealth aspect. So those people might buy from the people selling because it's not as good of a currency. But anyway, in any asset, I think it's good to figure out where these main groups of sentiment are, just to figure out what people might be affected by different types of news, and then you can use that to your advantage when trading. So I hope that made sense, and we're going to start next videos getting into my personal trading from the very beginning, from starting trading within the online game.